This episode's made possible by Planful. Hello, on today's episode of Planning Aces, we'll be featuring FP&A insights and commentary of three finance leaders, including CFO Don McGuire of ADP, CFO Scott Blackley of Oscar Health, and CFO Patrick Fleury of TeraWulf. This is Jack Sweeney, your co-host, along with performance management guru Brett Knowles, who will serve as our resident thought leader as we seek to highlight the takeaways from our distinguished group of planning aces. We'll begin after this. Ready to plan confidently, close faster, and report more accurately? Here's what sets Planful apart. Imagine purpose-built applications for every department, from FP&A to accounting, marketing to HR, all with built-in financial intelligence. It's easy to implement Planful in just weeks and with minimal IT involvement, so you can rapidly and seamlessly engage everyone across the business on your key financial progress. Best of all, Planful grows with you. Its unparalleled scalability ensures that no matter how fast your business expands, Planful can keep up. See why over 1,500 customers worldwide choose Planful as their flexible, user-friendly, end-to-end financial performance management platform. Go to planful.com/CFO Thought Leader to see how you can reach peak financial performance with Planful. Hi, it's Jack, and I'm here with Brett Knowles. Brett, as always, we want to give our listeners a sense of the underlying theme for the episode, and therefore try to answer the question, what do these three planning aces have in common? And to me, it was the effort to achieve clarity when communicating to stakeholders, no matter who they might be, whether it's your investors, your employees, your customers. What do you think?
The common theme about the three professionals we're going to hear today is their need to simplify very complex models. Now, some might be more complex than others, but it's that little metaphor of a duck where it looks nice and calm on the top, but you don't see all the scrambling that's going on beneath the surface of the water. Our job in FP&A is to create that illusion, that calm duck above the water, regardless of what it looks like below the water. And I think these three stories are great examples how in different degrees of business complexity and evolving business models, you can portray that calmness at the same time honoring the complexity of your business. And I think each of them does it in a unique way. What I wondered is if you plunked one of these planning aces out of their organization into one of the other two, would they be as successful? Or is there a match between their experience and skill set and what that particular industry or company calls for?
That's a really interesting point. I do think there are some of the people you're about to hear or what have you are perhaps a little more dynamic, or one of them, I would argue, had made their name as someone who could tell the story better than anybody, who that might be. And again, the more complex the business, the better at storytelling the finance leader or planning ace better be.
Yeah, that's a good hypothesis. And the underlying part is there's got to be a match between your professional style and the organizational need. So if you have a very predictable business, should you also portray yourself in a very predictable, staid, calm way? And if you have a very dynamic business with complexity and confusing business models, you need to be a little bit more flamboyant. I don't know what the answer is, but I think that these three gentlemen give us some interesting perspectives.
Okay, well, we'll keep your duck metaphor in mind. That is, all the action is under the water. Certainly, Don McGuire of ADP makes it look easy. He would have us believe that it has to do with ADP's highly predictive models. Again, a lot of uh, revenue streams are consistent because of the nature of payroll services, or at least that's what he explained. Just a few quick facts about Don McGuire. Was originally the CFO of Canada for ADP, opts out of the traditional finance career path to pursue opportunities overseas, where he emerges as a leader. Not only had a stint in the Far East, but he comes back and he's EMEA's president for a period of time before being tapped on the shoulder and asked to be CFO. And yeah, I think he would tell us he was a dark horse candidate for the role, but in a way it made sense because where the future of ADP in the minds of many reside is overseas, where expansion into new markets increasingly is a priority. And few, perhaps, senior executives are better equipped than McGuire, understanding some of the challenges that growing overseas. From episode 1030, here is Don McGuire.
Yeah, so FP&A has changed somewhat. I think because we're able to utilize models better than we had, models have improved. If you look at ADP, the beauty of ADP from an investor perspective is that our business is incredibly predictable. So we know how many people we pay, we know how much is recurring. The one-time revenue we get for setup or projects is it's significant, but it's not gonna move the needle too much. Our models are very, very predictable. And so what we've done over time is we've centralized some of those models and the people who work on those models across some of our BUs to make sure that we can leave the BU CFOs, if you will, to focus on more of the project type understanding and the intricacies of the competition in the various segments we're in, et cetera, and really leverage the FP&A folks more in a almost more of a back office perspective. They're sitting in the back, they're liaising and communicating, if you will, with all of the BUs, but they're able to build much more elaborate and much more predictable models that have been very successful in making sure that we hit our forecasts and meet the expectations and the guidance that we've issued to the street. I will tell you, I started off by saying it's great when you're an investor in ADP because we're so predictable. It's terrible though because you're so predictable. There's an expectation that you don't miss by 1% or 2% because you just shouldn't. Very much unlike my life at Black & Decker, quite frankly. If there's a bread maker one year or a snake light or a dustbuster feature, the year comes and goes on a couple of new products. At ADP is just much more predictable, but certainly has a very much different expectation around predictability and the consistency of the numbers.
Okay, a little insight into how Don McGuire looks at the FP&A function and just some more background. Don McGuire, I mentioned he was overseas, but for 20 years, and he only steps into the CFO office in 2021. And what's also interesting, I asked him among the things that most surprised him about the role, it's investor relations, perhaps that and how much time he dedicates there that he would say surprised him. And he told me I was spot on with that observation, all the prep that goes into it. So there's a lot of thought behind how he chooses his words and what he says. But Brett, what did you make of what Don McGuire shares?
Same as yours. Like it's interesting. It's a predictable model, and I love what you said that there's two sides to that coin. The good part and the bad part, and his positioning of FP&A is sort of a back office activity because in this world, that's what it is. It doesn't need to be bleeding edge, leading product development, leading market penetration, and so on. And then rightly severed off where there does need to be local knowledge applied to FP&A. In his mind, that was around special projects and sort of micro market dynamics, whatever those are, regional or product based. So pretty much what you expected. What was interesting is he took the role right before the pandemic. Now, pause for thinking. Everyone's payroll went into heck in a handbasket at that period of time because the employment model was changing. We're offloading, onloading people, working from home, and so on. None of that comes out in his conversation. This guy is cool as a cucumber. Like all this crap is happening in his market space, and he portrays it as just predictable going forward, no problems here. These aren't the droids you're looking for. I just thought it was absolutely an interesting style, given what's really happening in that space. And it's a space that's getting more and more complicated by different pay structures coming in. During the pandemic, for example, Amazon hired, I think it's 800,000 people. How do you support a pay structure that literally quadruples inside of a couple of months? And as quadruples, not going from 100 people to 400 people, but in hundreds of thousands. It's a market space that actually has more complexity than you think. Plus the overlay of regulatory requirements, like the taxation of payroll is incredibly difficult and changes frequently. And you think of all the regions they're covering, they must be dealing with changes every single week. Yet here's Don. It's a simple, predictable, easy business. I think there's more to this story than he reveals, and he tells the story as the investor wants to hear it. This is a calm, collected, staid business model.
So what you're saying is Don doesn't get to put it on autopilot and step out on Thursday and come back on Monday. The fact is that when something is so predictive, part of it is a responsibility. Expectations are set. If there's a snag or if there's a glitch, the price is going to be higher.
That's bang on, right? You can imagine if they had a security breach and 100,000 employees' private information got out, or they didn't catch some important regulation and they messed up 100,000 people's deductions and allocations and so on. So you're absolutely right that it does require an execution layer of precision. Now, the reflection of FP&A, maybe not as precise as the dynamics of those two examples I gave, but nonetheless, you've got to portray the business to investors as being above and beyond, those stressors.
Well, speaking of stressors, our next planning ace has been navigating the complexities of a post-IPO company inside the healthcare sector, which first off required a significant FP&A restructuring to adapt to a more volatile environment. This is Scott Blackley, CFO of Oscar Health.
When I joined, one of the things that I walked in the door with was a commitment to myself that I was going to be thoughtful about taking the time to understand the situation and then decisive about making decisions about people and organization. So, after 90 days, I did do a fairly significant reorganization. The FP&A organization was part of our controller's function. I split those two up, hired a person to run FP&A and started to build the bone structure there. We had a very what you would expect for a recently IPO'd company, just a very rudimentary financial planning process. And we continue to evolve that even through today. We've added a lot more bench strength and a lot more process to that. And, our business leaders now can explain what goes on in the long-term plan, as opposed to that being something that was, in someone's computer in our strategic finance organization. So there was a lot of people changing, process changing, and reorganization that I think was necessary to take us from a private company to a public company that could give guidance, that could, have our board have confidence in our plan, and that we could actually, as a finance team, be creating some insights for our business partners. One of the things at Capital One that I really learned in spades was that the wisdom of a crowd with people from different backgrounds and experiences is remarkably helpful to avoid, kind of getting sideswiped by a lack of awareness of a different perspective. On the other side of that is the absolute hairy complexity of healthcare. And so, I've got some general athletes that are in FP&A, but I also have some tenured healthcare experienced FP&A people. And we're trying to take the blend of kind of both sides of that, people who come from investment banking or who come from strategy and consulting, coupled with some people, who have been there, done that, and understand kind of where some of the challenges might be found in healthcare. We've tried to balance out across that spectrum. It's a terrific question, and I would say that today, when we look at our P&Ls, we have all of our cost structure broken down by activity and what it costs us on a per member per month basis. And FP&A really brought that to the business and helped them to start thinking about their cost structure in terms of what are variable costs, what are fixed costs. And those are pretty standard concepts, right? But as you're growing as a young company, you kind of just mix the paint. You just had this cost base and you needed some revenues to cover those things. And we've really evolved to where now when we look at our monthly financial statements with our whole leadership team, we go through all of the individual line items on what does it cost us for each member to do this thing, to do that thing, to, call centers, to process claims. So we've got a much, much, much richer amount of information, which, by the way, we can then benchmark against competitors and show our business partners, hey, we're pretty high on this particular cost. Why is that? What do you think? Here's what we think, and share our opinions.
Well, if I can just recap here, we had a great episode with Scott Blackley, episode 1031. And just a few notes on his background. He is the former CFO of Capital One. He sat in the CFO chair there for about 5 years. He had a stint at Fannie Mae during the financial crisis. And his earliest chapter is at KPMG, where he became a partner. And he was part of the KMG for like a decade before he moved on into industry. But Brett, what he had to share and just the number of balls in the air there seemed quite a bit. What did you make of all of what he shared?
Well, certainly, there's a big contrast, it seems, between the complexity of Scott's world compared to Don's. So there's this concept about complicated versus complex. So complicated, building a car is complicated. A lot of little parts and bits and pieces, and they all have to fit together and work, for hundreds of thousands of miles. But what's interesting about a complicated piece of equipment is, let's say you've got a piece of that car that's not quite made right. You write up a new standard operating procedure, a new manufacturing process, and every part from that point forward is made correctly. In other words, it's a standard, repeatable, reliable process because it's just a complicated piece of equipment. Complex is what Scott deals with. Complex is where the elements are non-predictable. Complex is bringing up an 8-year-old. Like, what you did yesterday is not going to work today. And so Scott's world is complex, whereas Don's is complicated. And that obviously takes a different style. And in a complex world, Don's world, you can do what he did, put FP&As in a back office because it's a standard, reliable, repeatable process that just works like a machine. In Scott's world, not so much. And so to decomplexify how I measure a complex business, he has, for example, separated the CFO office from FP&A. So in a complex world, you need processes which are more agile and more able to read that complexity. Now, pause for a second. It's important to note, though, that what happens in these processes like FP&A doesn't necessarily reflect the business. I'll tell you a story. The first time I bumped into that, we had a contract with British Aerospace. They're making the British Navy's nuclear attack submarines. And, a useless factoid, a nuclear attack submarine takes 25,000 man-years to make one submarine. Like, these are more complicated, apparently, than a space shuttle. So, very complicated piece of equipment, but in terms of managing the process, it's no different than manufacturing a tin can, which is really all a submarine is. So don't confuse the complexity of the business with the complexity of managing the business. The world that Scott lives in is a complex world. That doesn't necessarily mean that managing it is also complex. So think of an operating room, very complex things go on in that room, but it's just a room no different than a hotel room that I want to have highest occupancy for the highest paying customer and have the best results coming out of that room. So as we take a look at these businesses, we need to be careful that we look at the processes they're managing as opposed to the business that they're in. So back to Scott. What's interesting about Scott's world is complex. But they had the processes that he inherited were not suited to what the business now called for. And so what he didn't go into too much detail, he touched on a bit, obviously separation of duties, which good fiduciary step. But he talked about the richer models that they developed. So he began to work towards, even though it's a complex business, let's get the same sort of standard, reliable, repeatable processes in places that Don talked to us about at ADP. So I think that's Scott's journey of taking an FP&A model that didn't really suit the current manifestation of the business and evolve it to where it needed to be to run a bit smoother. Well, so what's also interesting about Scott and the work that he has done is healthcare is facing a crisis, no different than what he would have faced at Fannie Mae and other things. And the healthcare crisis in the States right now is all about cost management. Up till this point, it's a bit of a cruel thing to say, but cost was never an issue. Like, it was almost like an endless budget. And so inefficiencies got built into it. Now that there's this higher cost pressure, organizations like his have to manage costs in a way that they've never done before. It's like building a brand new muscle. And large health systems are having quite a difficult time in so doing because they just don't have the business acumen. They haven't hired that sort of skill set, et cetera. And so although Scott didn't go into that detail, he just brushed on it by talking about richer models. Those richer models need to be more agile and more able to identify cost saving and optimization opportunities in a very capital intensive, inflexible business. Capital intensive, I've got big buildings, big healthcare systems, big payrolls. Inflexible, I can't change the building. I can't, reconfiguring an OR is, millions of dollars per room. So it's just a more difficult business to work in than even running a bank.
And not knowing the full history of Oscar Health, I would tell you that Scott shared that the reason he accepted the appointment at Oscar Health was that it was entirely new IT systems. The company's been built from the ground up in the last decade or less, perhaps. And unlike other companies that grew through acquisition or what have you, there was never this big concern about how will we get these systems to speak to each other? How will the data find its way? So the systems were created with data in mind.
Yeah, interesting point. I always try to use a metaphor of greenfield, pillars, and anchors. So greenfield is what he had. It's a greenfield. You just build it from the ground up. You get full domain. Pillars are parts of your business that you can't change. If you change it, the whole thing collapses. And anchors are things that you've dropped that was arbitrary. You didn't need to drop that thing, and you could haul it back up and not be encumbered by it. The dilemma is we often confuse anchors with pillars. In other words, there's something that we've always done a particular way. We think it's a pillar. We think if we change that, the world will collapse, but it's not. It's just an anchor, and you can change it. And so part of change management is to figure out when it's a greenfield opportunity, when it's a pillar, and when it's an anchor. And don't confuse those things, right? You can have just as bad impact when you think it's an anchor and you go pull it up and you discover, whoops, that one was a pillar, and an important fault was created. So that's our dilemma in FP&A, trying to figure out what are the parts here that are dynamic in our models and what things we're stuck with.
I have to believe that this anchors and pillars metaphor has surfaced before.
Yeah, you could hear the PowerPoint slides being flipped.
You say anchor, and I get this image of this rusted piece of iron at the bottom of the sea with alongside the Edmund Fitzgerald.
Yeah, well, it doesn't matter if it's a brand new, spanking, shiny new anchor. It's still a bloody anchor that is causing unnecessary drag.
I'm on board. It works for me. No more questions. I will tell you our next planning ace is Patrick Fleury, CFO of TeraWulf, which is a Bitcoin mining company, or at least it's widely known as one. And over the last year, Fleury has advanced into a new realm of high powered compute. Patrick Fleury, I would say it was almost like a reluctant CFO. And you can hear his episode is 1032. So all three of these planning aces, all three of these CFOs were consecutive episodes, 1030, 1031, 1032. But Patrick Fleury would have us believe that he did not want to become a CFO. He was quite content being an investor, a savvy investor, someone who really could explain opportunities. At the same time, a management team that he had worked with in a prior life had been part of TeraWulf and starting up the Bitcoin mining company. He joins them, and I believe it's the way I think of it. He opens their eyes to this opportunity, and this is all about, I think, how Patrick is such an effective storyteller and uh, you know, has the mind of a finance professional, can understand the magnitude of opportunities and how to invest in them. Anyway, TeraWulf is now pursuing the high power compute opportunity. Clearly, they're not alone, but very few, I think, finance leaders can explain it as well. And it's the complexity, it's the clarity he brings to these two very different realms, we would think, Bitcoin mining and high power compute. The notion that he can explain why this company is well positioned to pursue opportunities in both realms is what makes, I think, this a pretty interesting clip. This is Patrick Fleury of TeraWulf.
I'd like to follow the saying, keep it simple, stupid, right? You have to make things very basic and easy to understand. And so with Bitcoin mining, again, I think it's a lot for people to comprehend. The Bitcoin network, how is it secure, right? There's a block every 10 minutes and that reward gets cut in half every four. There's a lot of just, a lot to bite off there. So what the approach that I've taken is, this is just like any other commodity business you have ever looked at. And you have to look at everything in unit economic terms. So what I mean by that is, if you're looking at oil and gas, it's in dollar per barrel. That's just right. That's how oil and gas works. And so Bitcoin mining, and by the way, in coal or in copper, it's like dollar per ton, or it's, dollar per pound of copper. Like, again, everything, most investors look at things in unit economics per businesses, particularly in commodities, because they want to understand where your company sits on the marginal cost curve. It's like basic economic stuff. And so for Bitcoin mining, it's very simple. When I first got in here, I just said, okay, what is our cost to produce a Bitcoin? That's it. It's really simple. It's based on what's your power cost, how much SG&A do you have, and what's it cost for you to operate your sites. There's only 3 cost inputs. And so for us today, power is by far the largest input cost, and then SG&A and OPEX are smaller. But generally speaking, today, like, I can tell you, we're mining roughly 7 Bitcoin today. Our fully loaded, literally every single cost in the company is about 40,000 per Bitcoin, and Bitcoin is on the screens today at 60,000. So literally, it's as simple as, I'm selling it today at 60, I'm mining it at 40. That means there's 20,000 of profit, and I'm mining 7 Bitcoin today. So 7 times 20,000 is 140,000. So today I will make 140,000 in profit. And if I keep doing that every single day, right? So, 140,000 over 30 days for this month, right? Then I'm making whatever that is, roughly $4 million in profit this month. And you just kind of repeat that. But that's so my approach, what really, when I came in, Jack, was, I think this business is really misunderstood because people it's complicated, but it's really not. When you think about what I am doing, I'm a mining business. It's just like a refiner, like Valero or ExxonMobil. It's the same thing. I have cost inputs, and then I'm a price taker. So it's exactly like the refining business in my mind. And so what we started doing 2 years ago was, I put out real guidance, just like any oil and gas company does. And most Bitcoin miners don't put out guidance, which, again, as a longtime institutional investor, I would never invest in a company that didn't tell you what their cost structure guidance would be for the year. That's what every single legitimate commodity company in the world does. And so why wouldn't we do that? So that was the first thing I did. I said, we need to start setting this company up so that it is institutionalized, meaning when it is acceptable for institutions to own Bitcoin, they look at us and they look at our disclosures over the last few years and they say, these are my folks, because what they're putting out reminds me of Valero or ExxonMobil or any other commodity business I've ever invested in. And now that I kind of can wrap my head around Bitcoin as an asset class, I'm going into this company because they are focused on ESG. They have a very diverse C-suite that has been together for years and years and years, and their transparency and disclosures are what I am used to. That was my goal. And really, after we fixed the company, because when I joined the company, we making payroll every 2 weeks was a challenge. And then once we got through that and we kind of righted the ship, it became, okay, let's now position this company for our moment. I don't know when it will be or when it will come, but let's make sure that we are ready and positioned so that when the folks that I used to work for come into this space, we are where they are coming. We are making a big move, really diversifying our business into high power compute and AI. So again, while we really think of TeraWulf as an infrastructure power business, That is the DNA of the company. It's not Bitcoin mining. So we have been mining Bitcoin because that was the highest and best use of the electrons that we were getting. Now, the highest and best use of that in the future, we believe, is co-location capacity. So we are building and then hosting some of the largest high power compute and AI customers in the world. And so we are targeting long-term customer contracts with those customers. And by the way, those customers are folks, hyperscalers that are in the Magnificent Seven stocks. So thinking of, Amazon, Google, Microsoft, Meta. There are, other folks that are building businesses. One of our peers just signed a long-term offtake with CoreWeave, who's an up-and-coming high-power compute AI company, and there's dozens of others. And look, this space, high-power compute and AI, I truly do believe with Jensen Huang said this as the CEO of NVIDIA, it will be the next industrial revolution for us. I mean, AI will be, I think, in even just a short 5 or 10 years, it will be pervasive. It will be in every part of our lives. And so right now we are at the tip of the spear, but what folks don't realize, and I think are starting to, is that requires a massive amount of energy. I mean, just a chat GPT search is 10 times the amount of energy as a typical Google word search, right? And that's, again, also just the tip of the iceberg, right? There will be AI uses in healthcare to analyze MRIs, right? I mean, it will literally be in every part of our life. And so where we are moving our company, and I think as I look forward, 5-10 years, I think we will be one of the largest public data center companies in the US, because we have a tremendous amount of low carbon, low priced power at our sites. And that is exactly what high power compute and AI operators need. And so we are sort of building the data center of the future to host those clients at our sites. So that's where we're headed. And so for me, the next 6 to 12 months will be executing and announcing contracts with those customers, and then actually beginning the build out of that capacity at our sites.
Okay, welcome to the age of high power compute. What do you make of what Patrick shared, Brett?
If we take a look at Amazon, for example, we're all around when Amazon started, showing up and selling books. And you go, well, that's a cute little thing. Barnes and Noble's gonna have a problem, but a nice, niche business. And look at it now, right? Amazon, whether Bezos knew it back then or not, wasn't a book seller. It was, e-commerce and a bunch of other stuff. Same thing here, that, you're presenting that the first market you're in is Bitcoin mining, but he's arguing that's not the real business that we're in. The real business we're in is high-end compute. And the important attributes and there are things like ESG and low carbon footprint and, all those other elements, which if you didn't know he was farming Bitcoin, you'd think he was in a completely different business. So he's describing perhaps what Bezos would have a decade ago of, this isn't a book retailer. This is, a new form of commerce that's going to look like this in the future. And you'd listen to him with the same skepticism that you listen to Patrick. You go, yeah. You're going to build these farms and you're going to have all this good stuff and so on. So there's that interesting underpinning. Again, nothing to do about the FP&A process, just an interesting business model that you take a look at. Where it does make a difference is in the FP&A world, are you planning around Bitcoin mining, or are you planning around building these huge infrastructure nodes? And his answer is, we're using Bitcoin to finance building these infrastructure nodes where the real money is. So in that context, FP&A becomes a super important strategic lever to grow the business. In other words, if he did not have that mindset of trying to build these infrastructure nodes, the business of tomorrow could never be hatched. It's the work he's doing today when it looks like Bitcoin mining is planting the foundations for what the corporation is going to be in a chunk of time.
All right, let me compare what Patrick shared and his thinking with that of Scott Blackley's, and you get to share, make a comparison between Patrick Fleury and Don McGuire. I think that one's going to be a little harder, but the two of them focus on simplifying, and I mean Patrick and Scott, on simplifying complex industries and establishing financial clarity. Fleury simplifies Bitcoin mining by emphasizing cost structure and profitability, drawing comparisons to traditional commodity businesses. And similarly, Blackley emphasizes, well, reorganization and a clear financial planning process to better drive, long-term insights into the business. Now, tell us about Patrick and Don.
And now, what's interesting about Patrick is, as you say, he's dynamic, charismatic, and so on. And you know it. You know when he's talking that he's pulling a line, and like any good fish, you're chasing the shiny lure. I don't think his story, though, is significantly different than Don's, talking about ADP. Don's twist on it is nice, simple, straightforward business. Patrick's is, this is just a commodity. You're just buying stuff, you're selling stuff. These are numbers I make. Great. If the interview ended then, we would have gone home going, well, it makes sense, the new nickel or gold mining. But then he actually accidentally tipped his hand. He goes, but what's really happening, the little legs underneath that duck that looks like it's just floating along, we're building these infrastructure nodes that have all these other characteristics that allow us to get after the Magnificent Seven. And all of a sudden, this completely new business model emerges. So the first half of the story is, this is not dynamic. This is boring, simple, straightforward. It's no different than the story that Don told us. Then somehow or the other, I don't know whether he got weak or you tricked him or something, but he opened up the kimono and a completely different animal, emerged from the story in the second part. And if you listen to the first part of the story and didn't listen to the second, you say it's just a mining operation. If you listen to the second part of the interview without hearing the first, you'd see a completely different business. So I think what's interesting is Don, Scott, and Patrick all told their stories as they thought you wanted to hear it, or as the investor wanted to hear it, or in Patrick's case, as he wanted to tell the story. But there are other layers to that which are not being told that makes their job as an FP&A person more complicated, more strategic, more long-term impactful. And all of them nicely packaged it so that the scrambling legs under the surface were never seen.
I knew the duck would resurface, turn his head.
An interesting collection of FP&A people because of their differences and because of their similarities.
Oh, and one other difference that I failed to mention regarding Don McGuire, and it's something you and Don have in common. Don is a Canadian.
Good place to come from, I would say.
So you tell us. For Planning Aces, this is Jack Sweeney on behalf of Brett and myself. Thank you for listening.